How are you all? It's 9. G'day, Dawn. How are you? It's not 9:30, and I think we need to start kicking off proceedings once Robin can just confirm for us that we are online. We have a number of external guests, so to all of you, I think I've shaken your hands, but welcome. We look forward to the contribution you can all have, and to Basil over the back there. It's great to have you here too, and appreciate you being here. So I understand we're now live, which is tremendous, and everything will be public in this public session, including on YouTube later. I have been accused of mumbling into the microphone, so could I all encourage you guys to not follow my lead, but make certain you are loud and clear and use your microphones as appropriate, please. And if you're not speaking, can you turn them off? That would be tremendous as well too. Thank you very much. We have a suite of very good papers, so before we get into the hurly-burly of discussion and dealing with those, Marty, if I could just pass my thanks on to staff for what I think are a very good set of papers. They're ones that raise for us a number of quite key issues around both financial management and also when we get to public excluded around risk. And they do provide the platform for good and useful debate. So again, as I say, Marty, thank you to your team for what is a good platform for us as governors to be able to do our work. Apologies. Do I have apologies from you? It looks like a full turnout. Are we able to keep you here the full day? I hope so. Thank you. That's great. No apologies. We'll move on. There is no public forum in the sense that no one's booked. So I will note that. I haven't been advised of any late items, and I haven't got any sense that there are any coming. Are there any matters that are confidential business to be transferred into the open? I haven't. Yes, John.
Yeah, thank you, Chair. Some of the issues that we will be discussing under the subject of risk, I wonder if we could give some consideration to bringing some of those into the public domain. They don't seem to be issues that, if they were in the public domain, would create additional risk, nor do they seem to be issues, some of them, of commercial sensitivity. So I'm just wondering if we could at least consider bringing some of those items subsequent to discussion into the public domain. The Chair is obviously familiar with the agenda. There are issues that have been the subject of public discussion, were actually subject to discussion in the chamber just last week. It seems to me that bringing those into the public domain subsequent to discussion would not be in any way damaging to the organisation, perhaps might even be reputation enhancing. So,
thank you there, John. I think I take your advice that that's, with each of the public excluded items, there is a discussion, there is a need to check what should or shouldn't be made public. So I'll take your advice on that, and we can, as a group, work on that and see where we go to. Thank you. Are there any other comments on this area? There aren't. Change the order of business. Again, I'm proposing that we follow through. Most critical to me is when do we have a break. I'm suggesting that we work through to 11. Robin's advised me when we'll take a 10-minute break and see where we're at in terms of the agenda, and lunch is provided at 12:30, and I'm proposing a 45-minute break, and we'd reconvene at 1:15. Of course, as you know, with me, I never keep to time. So I'll put those dates out there, and one of you can be the timekeeper and say, Bruce, your time is up. So there we go. That's tremendous. Right, if we could then move, please, to item 6. We have a couple of sets of minutes to confirm, but we will take them as separate matters. The first are the minutes of our meeting on the 26th of May. Seems like a long time ago. Can I have a mover, please, for those? Thank you, Tim. Do I have a seconder? Thank you, Tina. Is there any discussion on those minutes? Any matters of factual correction or the likes? We're right? I'll put that, please. All those in favour, please say aye. Aye. Those against? It's carried. Could I have a similar motion, please, for the minutes of the 30th of June, our most recent meeting? Thank you, Calvin. Can I have a seconder? Thank you, Dawn. Is there any matters of correction or factual error in those, please? They look like they were the meeting I was at, which is always quite good. Can I put the motion, please? All those in favour of the motion, please say aye. Aye. Those against? It's carried. Tremendous. Thank you very much. You've all had a chance to look at the agenda. Are there any matters of interest or conflicts of interest that anybody wants to raise at this point? We're fine? That's great. Good. Right, so we're up to item 8, which is deputations, presentations, petitions, which is actually a long way of saying welcome, Andrew and John. Great to have you guys here. For those of you that don't know, Andrew in particular, are you a foundation employee of LGFA? Andrew, you must be just about, mate.
I think they started about 6 months.
Okay.
I think they started with like 2, and then after
Yes.
6 months it was 4, and now we've just taken on an intern, so now we're 9 people.
Right.
So you think we're not that much smaller than Kiwibank in terms of total assets, but considerably smaller than in terms of staff.
Okay, well that's great. So look, Andrew, John, welcome here. Their work, it's fortuitous because of the item that follows, where we consider our Treasury management policy, and obviously we've also got a paper, Andrew and John, with your upcoming AGM to consider our position as far as that's concerned. So look, over to you, John and Andrew. Very happy to give you the floor and hear what you've got to say to us, please.
Okay, thank you. So my name's Andrew Meikle. So my key role at LGFA is to monitor the creditworthiness of councils. So while one of our key priorities is to lend money to the sector and provide cheaper financing, we also have a responsibility to all the council guarantors to ensure that when we lend money to councils, that those councils remain in compliance with their financial covenants. John Avery is one of the independent directors, so I think John's been involved, he has been involved from the start, so he actually superseded me. I'm not going to go through all of these slides, I'll just go through a few things. So firstly, just to reiterate, so LGFA was modelled on similar entities, and the longest standing ones are in Scandinavia. So the one in our equivalent in Denmark's been going for over 120 years now. And I think the benefit of the LGFA model can again be seen this year when you get a lot of volatility in financial markets. It's been really good for the sector to have its own financing entity. So councils are free to borrow from any source that they want, so you don't have to borrow through LGFA. So you can issue bonds or borrow through sort of banks. But again, we saw the benefit this year that when we reached and through March, April, when financial markets became quite dislocated, share markets were falling, there was no corporate bond issues going on anywhere in the world. And what we got was the government extended the standby facility and increased the size of it, so from 1 billion to 1.5 billion. We've never drawn down on that facility, but again, it showed government support for LGFA. And the second thing that occurred was that the Reserve Bank announced that they would buy back government bonds, but they also added LGFA to their repurchasing that they were doing. And so the Reserve Bank's actually bought over $1 billion of LGFA bonds in the secondary market. So again, that government support for LGFA is a really good thing for the local authority sector. Recent developments, we're now up to 70 council members out of the 78 councils in New Zealand, and we've got another 3 that are in the process of joining. It's taken a while for a lot of smaller councils to join, and that's largely because they have had no debt, and so there hasn't been a pressing priority for them to join. But now they're actually realising the benefits that even if they don't need to borrow, just having the flexibility to be able to borrow if their circumstances change is a good thing. So we're now down to just a few small ones like the Chatham Islands and things that we're not sure if they will ever join, but pretty much the whole sector has now signed up. The other thing, just we've got a couple new product initiatives. So one is standby facilities. So we're going to provide standby facilities to councils if they want to use those. And again, it's just providing an element of competition against sort of banks. So banks, because of their requirement to increase their capital over time, there's going to be upward pressure on the cost of standby facilities. So just us entering that market hopefully keeps the banks honest. The second thing is we are going to start doing green and social and sustainable lending to councils. So this has been a global development that there's been globally increasing emphasis by investors to invest in companies that issue green or sustainable bonds. So we've established this sort of criteria, so we're now going to be in a position whereby if a council wants to issue a green bond, we're going to be able to facilitate that for them. The AGM is coming up in November, so happy to answer any questions. I know it's on your agenda, but we do have contested elections for the first time for the non-independent director role and also for the places on the shareholder council. We've got a few changes to the foundation policies, and that just simply reflects that the size of LGFA's liquid asset portfolio has grown. So probably 3 years ago we might have had 400 million in liquid assets. We're now sitting on about 1.3 billion. So just widening the criteria. It's nothing about trying to increase returns, it's just trying to allow us to have more diversification. Otherwise we end up being highly concentrated in the big four banks as the exposures. So again, that's good for you that we have a large liquid asset portfolio, because it just gives us sort of flexibility when you get dislocation in financial markets, that we have a large pool of funds that we can sell down and lend to local authorities. I was just going to touch briefly on the impact of COVID. So back in April, when the crisis sort of hit, we were working quite closely with DIA, Solgum and LG&Z in terms of assessing the impact on the sector. So at that time there was 2 reports that DIA sort of put out, and the second one estimated that the fall for this financial year in revenue across the sector as a whole was going to be between 2.3 and 11%. The first cut that they did was actually forecasting a 20%. So when they actually went and surveyed councils, got more information, the impact wasn't as bad. That said, the impact will differ between sort of councils. So if I look at what's happening in rural councils, there's almost no impact on revenue. The metro councils have a much bigger impact, and that's because they have, parking fees, more stadiums, zoos, in Auckland, the regional fuel tax, so and commercial activities as well. So the metro councils are definitely affected a lot more than the rural and provincial councils. I suspect that the actual outcome is going to be at the lower end of that sort of band. The DIA scenario was based on New Zealand remaining in level 2 through till March 2021. And while it's been a little bit choppy, certainly we've moved back to level 1 a lot earlier, and we've seen a bounce in economic activity back a lot quicker than what was sort of forecast. Again, back in sort of April, there was a little bit of uncertainty about NZTA revenue going forward. So had we remained in level 2, 3 or 4, there potentially was going to be lower road usage, and therefore NZTA's revenue could have been under pressure. So all councils have adopted their annual plans now. We saw a range of outcomes in terms of rates. So pretty much all councils reduced the forecast rate increase that they were sort of planning. A number of councils adopted a 0 rate increase. A couple did a rate decrease, but by far the majority adopted a modest increase in their rates. One thing that surprised us was more than half of councils were forecasting a balanced budget in 2021. So we thought, there'd be a lot more forecasting a modest balanced budget deficit in the current sort of financial year. And the average across the sector turned out to be 104%. So again, that surprised us. That said, there is an element of one-off government subsidies that some councils, but not all, are getting, and that has helped those balanced budget outcomes across the sector. In addition, there's going to be the government sort of grants in terms of the water funding. So a lot of councils wouldn't have built that into their annual plan, but again, that's actually going to be on top of what councils were forecasting. And what we saw is very few councils opted to reduce sort of levels of service. So again, depending on how the economy sort of progresses over the next sort of year or two, that's something councils are going to have to weigh up when they do their LTPs if the economy doesn't recover and you've got that issue of rates affordability. Levels of service is something that's probably going to be discussed. I would say, it's often the first year it actually turns out to be the easy year. So in terms of affordability, this year we've had, the wage subsidies, a lot of sort of government spending. So often the harder decisions need to be made when those subsidies actually sort of run out or are removed. In terms of the impact on councils, so one good thing at the moment is interest rates are significantly lower than they were sort of 5-10 years ago. So councils' ability to service their debt has been improving quite significantly. So if you look at, say, net interest to revenue, in 2013 it was just over 7%. Last year it was 3.5%. So it's council's ability to service their debt is twice as good as it was 7 years ago. And councils will benefit further because most councils do hedging of their interest rate debt. As those hedges mature, again, councils will get the benefit of lower interest rates. And again, council debt has been increasing significantly over the last sort of 10 years. So intuitively, you'd actually think that council's net debt to revenue ratio would be increasing. But if you actually look at the average, again, 7 years ago for rated councils, the average net debt to revenue was 111%. As at last year, it was 68%. And that will change because there's a real change in sentiment towards doing CapEx across the sector. So councils are going to be a lot more ambitious in their CapEx programs than they have been in recent years. But the good news is across the sector, on average, that the starting position that we have today is actually better than maybe you would intuitively be thinking. And that's been reinforced if you look at the number of credit rating upgrades that have occurred over the past 5 years. I think the last downgrade might have been Christchurch in 2013 or 14. And since then, no council has been downgraded, but we've probably seen, 10 to 15 councils have their credit rating, including Tauranga, upgraded. And the highest net debt to revenue ratio as at last year was 180%, which was Kapiti, versus the maximum net debt to revenue cap under the LGFA covenants at 250. But if you go back to when LGFA first started in 2012, 2013, there was probably 5 or 6 councils that had net debt to revenue over 200%. The last thing I probably wanted to touch on is just the change in the net debt to revenue sort of covenant. So councils approved this change in June this year. We discussed this with the rating agencies. So when we made this change, we wanted to make sure that it didn't impact on LGFA's credit rating, because if LGFA was downgraded, then the cost of financing to the whole sector would have increased. But we've actually increased the net debt to revenue ratio, and over the longer term it's going to move from 250 to 280. We've got a little bit of a complicated formula over the next few years, and the drivers were twofold. So firstly, we recognise that potentially council revenue over the next few years might be artificially lower than it would otherwise be because of the impact on COVID. So we didn't want to measure the covenants on an artificially low revenue number. And the second is we wanted councils to be able to co-invest with the government if the government offered them those opportunities. So back in April, when we were sort of thinking about this, we didn't know exactly what the basis of shovel-ready projects, for example, would be. So we didn't know if the government was going to say the council has to put in half the money and the government will put in half the money. So we wanted to give councils the flexibility. And the third factor is, compared to when LGFA was set up in 2012, growth rates or population growth rates have been a lot higher than forecast. So again, it's just giving some recognition to the growth councils that they need a little bit more headroom to be able to cope with the impact of or providing growth infrastructure. So I'm happy to finish there and take any questions.
Thank you, Andrew. I certainly have got one stacked up from John, I think, first. But John, board member, I just wondered whether there was any comments you wanted to make from a governance perspective of LGFA before I open up to the floor, if you had anything you wanted to say. Appreciate that.
From a governance perspective, the company is functioning exceptionally well. We've got an excellent chair, CEO, and exceptionally good team supporting us. We get good advice from our independent advisors and try to tread the line that is both cautious yet delivers what our shareholder councils require. One thing though that I do see that the likes of the Taurangas need to just keep on board is that we have a body of which Tauranga is a member, the Shareholders Council. But we do have a lot of borrowers who are not shareholders. In fact, most of them are not shareholders. So we're trying to make sure that we that we focus on all of our borrowers and make sure that we treat them as equitably and as we can. And it's an issue that I guess the Shareholders Council has to try and grapple with, that how do they bring into the fold or keep inside the tent, so to speak, those that didn't sign up for a shareholding back in 2012, because there's been no changes in shareholding since that time.
Thank you, John. Appreciate that. John, you've got a question?
I have two, thank you.
Okay, right. Okay, go for it.
And start with the governance one, if I may. I did note the heavy weighting of the Bay of Plenty, Western Bay of Plenty on the Shareholders Council. We have Tauranga City Council, Western Bay of Plenty District Council, Bay of Plenty Regional Council. On that. Do you have any comment to make about that geographic intensity there? Are we just smart and clever and in early and doing a great job for our citizens, or is it...
You're smart, clever, and in early, and doing a great job for your
That'll do
citizens.
me.
That's been the diplomatic response, I suppose. Look, it's a shareholder issue. It's not up to us to be saying who ought to be at the table and who ought not to be at the table. I'm sure if I said that, you would take umbrage at it and say, learn your place, my friend. Obviously having a geographic representation is good. From my experience in organisations, member-driven organisations, one of the things you do have to, I think, always take into account is that some of the larger, more vibrant, progressive organisations are the ones that provide the grunt and the impetus in going forward. And if you get too all-encompassing, you run the risk that you water down your membership and you don't become as effective. So am I trying to sit on the fence? I think you folk in this region do a very good job. You can be very proud of what the Bay of Plenty stands for, has achieved. But it would be good to be able to be more representative in lots of ways, but I'm not, I won't proffer an opinion.
I apologise because I know there is a decision to be made in that area, but you did open the topic. More to the point, going back to the presentation, talking about the debt revenue ratio, the sector debt revenue ratio, you didn't make clear, and I raised my hand at the time, is that a weighted average or is that just the average? Because it does make a significant difference. So you had the sector debt revenue ratio.
This is sector debt, so you can see what sector debt's been doing. And when we look at change in net debt levels, and I'll put up the slide on the sort of covenants, what you can see is for rural and provincial councils, actually over the last 5 years, their net debt has actually stayed the same or even sort of declined slightly. So sector debt has been driven largely by the metros and in particular by Auckland and Christchurch. So that does come back to your point that if you look at a weighted average thing, you get quite a different outcome. So if you look at, the average, because it's two councils have been driving the growth in sector debt, their net debt to revenue ratios have been going up, whereas the rest of the sector, on average, debt hasn't increased. So for the average council, their net debt to revenue has actually been falling. The other reason is, debt has been going up, revenue's been going up very strongly as well. So that's the other factor. So if your debt has been staying the same, but your revenue's been increasing, then your net debt to revenue ratio has been going down.
So for clarity, the figure you put up there, was it a weighted net debt to revenue figure? It was
simple average. Yeah. If you took a weighted average, you'd get a different number. So your point is a good one.
Yeah, Andrew, I got excited when you started comparing yourself to Kiwibank. I thought we might have had a local branch opening for affordable house loans. Just two questions. One on the green loans, or the green sustainability and so on. I think I heard you say that's only for bonds, because there's no different conditions for borrowing for sustainable projects, are there? It's just if we're raising money through bonds. Is that correct, to clarify?
Yeah, so the issue is that we see it a little bit in New Zealand, but it's probably even more prevalent in Europe, is a lot of the large institutional investors are looking to do things that are environmentally sort of friendly or ethical. So we had a little bit here in terms of the Kiwi Saver funds probably say we're not going to invest in tobacco and ornaments and things like that. But more and more they're starting to ask questions in terms of things that are environmentally sustainable. So it's just, globally, less in the US, more in Europe, just this is what is happening. So at the moment, what we're getting is a lot of questions from investors. So when we lend money, what is it being used for? Investors are less probably worried about the local authority sector than if we were a mining company. So you can imagine if you were BHP and things, there'd be a lot more drilling down into what we were doing. But
Not drilling.
Oh, sorry, not drilling. But we still need to be able to answer the questions that are asked. We've seen Auckland Council issue a couple of green bonds, so that is largely backed by their electric trains and some of their CRL project. So again, investors, when they buy a bond that is, called green, they can sort of tick a box and saying we're doing something that is good. One of the challenges is there isn't any pricing benefit in sort of doing this. So it would be a lot easier if there was. However, LGFA's desire to participate in the green bonds and sustainable bonds is, if we don't do it, we're going to sort of be left behind. And we've also had pressure from a number of councils as well to say, when are you going to do this? So there's two parts. One is when you borrow, we'd be able to issue you a green bond. And when we have enough of those assets, we can then go to the market and issue our own green bond.
The second one, if I may, Mr Chair, just with your viewing of all the councils across the country, just any observations when you talked about, we're all benefiting from the low interest rates, funds coming off hedged and so on. Are you seeing any changes in the way councils are fixing, floating and hedging because of the historic low rates at the moment? Hedging costs us money, so are we seeing a shift away from that necessarily?
We've seen, historically there was quite a large number of councils that didn't have debt or didn't have a lot of debt. But as that has slowly changed, we've seen more councils using advisors, so that is Bancorp or PwC in New Zealand. So I guess that brings an oversight or more sophistication in the management of council's debt. And as debt portfolios become bigger, it simply justifies the cost of putting more money, I guess, or resources into the management of that portfolio. What we see from a lot of the small rural councils, if you have probably less than $20 million worth of debt, they tend to just borrow fixed rate and might split it over 4 or 5 maturities, and it tends to be quite short, maybe 3 or 4 years, out to 3 or 4 years. The larger portfolios, if you look at Auckland, are now up to about $9 billion of debt. When you have that much debt, you have refinancing issues every year, so you simply have to spread it over more years, and we saw Auckland do a 2050 maturity this year in their own name. LGFA's gone out to 2037 in terms of what it can provide to councils. But yeah, the larger the debt portfolios, I suppose the more expertise you need to bring in terms of the management to ensure those risks are well managed. Interesting, next year, so again, we're not advisors, so maybe it's more Bancorp's thing, but it's still the market's expectation as we get a negative OCR sort of next year. So the interesting thing is it's highly possible that we'll pay you to borrow. So it will change the economics somewhat.
Thank you. As you know, I've been quite outspoken about this and the increase of debt at a time when interest rates are at such an unprecedented low period, and I think your point was well made that we may indeed be asking you to pay us for the privilege of borrowing your money, and we're very grateful for the opportunity to do that. The reality, of course, is that that's a dire position and is unsustainable for the country and will have, again, an impact on housing. How do you see, though, this playing out in times to come? We do have an opportunity at local government to make hay while the sun shines, and by that I mean, borrow to a point where we can get things done and at these low levels of interest. Is there an appetite for that, or do you think we should really be looking at the SPVs that are being mooted and, in my view, in a clumsy way? I know that some of them, one has been formed, but it's hard to use. In terms of if we were in the private sector and talking about a private equity SPV, it'd be a lot easier to use than what the one is that's been proposed by the minister in his role, Minister Twyford. But do you see SPVs real off-balance sheets coming? Because again, as I understand it, the off-balance sheet structures that we could have available to us are now recorded as effectively back on balance sheet. So it's a net sum gain for us. Or is it all about the three waters?
I think you've probably summed it up quite well. So I think in terms of investment in infrastructure, there's been a real change in attitude over the last probably 5 years, and things like the creation of the Infrastructure Commission is a good thing for New Zealand. But across the sector, just the willingness now to do sort of greater capex, to put more resources in terms of council's understanding of assets, it's all really good news. And again, Bruce did the report, I can't remember what year you put out, report into the infrastructure deficit in terms of sort of renewals. But again, it's good that we're having these discussions. In terms of the SPVs, I agree with what you say. I think there was a lot of political pressure to look like, the government was doing something, so it all got pushed through for political reasons. Yes, there was the project done in Milldale. The issue is someone still has to pay for this, and actually using SPVs is actually a more expensive way than if the councils could do it in their own name, or even if the government sort of could do it. So I've been to different sort of workshops, and I don't know that you're going to get huge uptake because you need the scale, you need one big landowner. You can see it in South Auckland now in Drury, where Auckland Council says we haven't got $1 billion to put the infrastructure in, and it's not in our plans, so we can't do it. Are they going to use an SPV? Maybe, but if house affordability is the issue, you're putting yet another levy/rate on house owners. So
Thank you for that. John, question?
Yeah. What relationship, this is a really interesting topic, particularly for us when we're in not dissimilar situation. The jury situation is bizarre. Even more interesting is there's a 29-year-old planner who's running the whole show from Auckland Council's perspective. That's a job from heaven for a planner. You come back to that conversation between central government and local government. Are you in that conversation? Because there's a bigger issue here, and one is, even though money is freely available, the infrastructure industry doesn't have capacity to actually do anything, so we can wind up in the perverse situation of borrowing a lot more money to pay a constrained infrastructure industry a lot more money to actually get the same outcome, because their prices have risen because all the councils are fighting to have work done. And Infrastructure New Zealand have raised this constraint. So I suppose my question is, are you talking to central government, and in those conversations, have we broken out of the financing silo into the financing funding silo, but also in the supply side conversation? Are they integrated conversations that you're party to, if you're party to these conversations?
So we certainly do talk to DIA, MIMBI, Treasury, but a lot, I don't want to be too critical of government sort of policy, and that's why I quite like the Infrastructure Commission, because it's thinking about what we need to do as a country sort of long term. When you look at the productivity report into sort of rates, affordability, again, I think it's about the 15th inquiry since World War II, but the central government's essentially reluctant to give local government more funding tools. And if the local government had more funding tools, then it could do sort of more infrastructure strategy. But the government wants to keep all the control, and so you end up with this piecemeal approach like with provincial growth fund and shovel-ready projects. So rather than a good coherent strategy about what is the best thing we should be doing as a country, you end up with, you know, politicians wanting to divert money to Northland and things, you know, I mean, it's, but the question should be what is the best thing for the country, and have a long-term approach rather than 3-year sort of approach.
Andrew?
I mean, you probably, as a council, you know, you see exactly the same things.
Some of us are involved in Northland, Andrew.
It may be a good place to invest, but, you know, with things like roading and rail, we should be taking a national approach to where we're going to get the most sort of productivity.
Yeah.
Again, with jury, it's crazy when you look at the need for housing, and yet we just get this disconnect in the way it can be funded and financed.
Thank you for that, Andrew. Thank you, John. I would like to draw it to conclusion. I think we could probably talk a long time, but this has been very helpful, Andrew and John. Look, like every other council, we're in the middle of the long-term plan. We have to think about what are some of our options, and particularly how to fund them. So it's been very useful. I was going to ask you, what's your crystal ball for next year, but we can leave that for a later conversation once subsidies come on. So, look, on behalf of the committee, thank you for your time. I do appreciate that, and it's certainly going to help us with both the AGM matter we've got coming up, but also considering our Treasury management policy. So I do appreciate your time. Thank you for being here. It's a wee way to come, so I do appreciate that.
Thanks for the opportunity.
Always nice to come here.
Good, thank you. It's lovely to see you. I wonder if we could move then, please, to item 9.1, which is the Treasury policy review. I think mine probably in your hands, please, with your guests, Ross and Suresh. Welcome to the meeting, you guys.
Good morning all. Got Suresh and Ross here from Bancorp Treasury Services. They were engaged to review our Treasury policy, which is a 3-year cycle, and there's a short report there, and I can cover through the charts and stuff on there, but these two gentlemen are going to talk through the detailed pages of the actual policy itself.
Yep, great. Hi. Okay, so we've got the whole policy. I understand people were quite keen to do a page turn. Is that correct?
Look, I'm reasonably relaxed. I think Moen has headed us towards the salient changes.
Yes.
And I wonder if you could focus on those, please, but then when we open it up for questions, if councillors have other points, let's go through that. I think that would be the way, unless my colleagues want to go through on a page-by-page basis. I think we'll stay, Suresh, with the key points, please, and see if we can get you from there, please.
Okay, all right. So I think that the key thing that we've addressed in this review has been the interest rate risk management bands, and clearly, the trend with lower interest rates has had an impact on that more recently. But even over the longer term, the trend has been to reduce hedging duration. Clearly from our perspective, and sort of give you more flexibility within a smaller confine. So from the bands that we had there, I mean, previously the council could hedge out to 15 years. Now what we've done is we've shortened that to 12, and we've changed the band. So instead of having 0 to 3, now we have a 0 to 2, for example. A 5 to 10 has gone to a 5 to 8. So effectively we're just shortening where or how long we can hedge. Now, and then one of the other things we've done is just increased the 0 to 2 band from 30 to 40, which seems counter to what's happening with interest rates, but 2 years disappears quite quickly. Now, we have been unwinding or bringing back duration now for a few years. And we certainly did not see this latest bout of COVID which the pandemic has taken interest rates to zero. And in fact, we are now seeing negative interest rates being traded. The 2 and 3 years have traded at a negative yield in the last couple of weeks. And so therefore our view was to try to reduce the quantum of hedging that councils were doing, because structurally we saw a lower interest rate environment developing. Now, one of the questions that may come out is, well, hey, now that we're at close to zero, why aren't we going longer? And that is will be a good question. But what we have been doing for the last number of years is reducing that. So we haven't taken account of the fact that we are at zero, that you could go and do something ridiculously long. But we're also wary that now that we're in this low interest rate environment, it's going to be quite hard to climb out of it. So really the risk for interest rates going forward might only be between 0 and 3, 0 and 4, worst case. So, we still have that bias to shorten duration. So that is one of the key measures or changes that we've made. A lot of the rest of the changes were sort of removing some elements of the policy into appendices, because that has been the trend. 40-page policies are now becoming 20, but we're still well aware that some councils like to have a comprehensive policy because of the readers that may want to look at it outside the actual council. The other key things really have one is we've changed the liquidity funding risk. You used to have sort of structured bands that you had to have 0 to 2, 3 to 5, I think 5 plus. And one of the reasons we've just brought it back is to say is no more than 33% in 1 year. And we've been working on that for a while, is to give greater flexibility when Mohan is looking at funding and being forced to sometimes fund longer where the premium or the margin starts to rise. So we've seen a trend that people want to reduce margin, credit margin, not the actual base rates, and being able to have the flexibility to put them where the market is developing at times. At the moment people are doing stuff in 5 and 7 and up to 8, and so we just thought that is a much more flexible way to manage the funding risk. Yep.
I just wanted to add to that that the LGFA has obviously done an extremely good job in providing that liquidity into the market and ensuring that when Mohan does go to market, there is always something there. So he doesn't have to, spread those maturities out so far, because he can be confident that in 3 years' time the LGFA will still be there.
And one of the things that we've put in, all the rest is sort of superficial. We sort of tweaked a few little percentages and just sort of brought up to best practice. Was put in a benchmark. Now that benchmark is a calculated number which assumes the midpoint of policy. So with the bands that we've got, what that means is that you're always at that midpoint. And it works on a basis, it's a rolling monthly benchmark, and it assumes that every month that you're doing 1 million or adding 1 million of hedging to stay at the midpoint of policy. So the benefits of that shows that if in a downward environment, being below midpoints obviously gives you an advantage because interest rates are falling, but if there was a climbing interest rate market, which I can't remember when we last saw that you'd probably be at maximums, right? So this whole benchmark just quantifies what that midpoint is. Now, when we go into this, of course, we're going to be quite close or above that benchmark, because our benchmark is we've now changed it, and we've got existing hedges in place, which, over time will unwind. Okay? I think that's the key points, if there's any questions.
Thank you for that, Suresh. Are there questions? I want to encourage councillors. It might seem like a naff way to say it, but if you have questions of needing to understand or have things explained, I'm quite prepared that we take the time. This is reasonably critical. It's a critical part for Paul and Moen to manage on our behalf, And I think it is useful that we do try and understand the core tenets of what our friends from Bancorp are recommending. So I would entertain a few questions. I think, Kelvin, you're on the starting peg, please.
Thank you very much. On page 29 of our agenda, the graph at the top of that page, so it's actually paragraph 15, talking about the benchmark. So just to clarify, the reason why our actual interest rate is above the benchmark is because of the hedging we've undertaken, and that will slowly get closer to the benchmark over time. That's the objective, right? Just to clarify that?
Yes. It's kind of, we've completely changed the policy, but you've already had an old policy that you're measuring. So yes, that is how it will pan out over time. Yep.
My observation, Kelvin, and you can correct me if on this one, Suresh, is that many councils are probably faced with a similar metric, unless they're like Andrew's comment in the LGFA presentation that they've been reasonably recent entrants to the market. And for those that have been reasonably recent entrants, their profile is much more enviable than ours in that sense. Yes, so Tembi and then Larry.
Thanks, Chair. I think, Paul, refresh my memory, but we looked at, we did a calc on refinancing in the circumstances, and I think our weighted average cost of capital was such that it might have been, it was a line call, as I remember. Help me with this, Paul, I can't remember the figures now, but, you know, to refi to get down to the benchmark at whatever that is, 1.5% or something, I think was just a line call really to do it. But I do wonder if because of this downward trend, you know, we shouldn't relook at that. Just a thought, really.
So through the chair, it was, and Mohan can probably tell the exact number, but it was getting north towards the high 80 million type mark. I think that refinancing cost.
It's about 70 here, in that sort of ballpark. That number we're bigger now. As, at that time, interest rates have gone down further. One thing to add to that benchmark thing is that we do have margins we pay as we borrow, so which is about average margins about another 0.74 at the moment, so it'd be adds on to that our average rate. I think it's about 3.42 at the moment, end of October or end of September. So benchmark is exclusive of that margin. For example, if we borrow now for 10 years, assume the OCR has gone negative or the 10-year rate is 0, we still have a pay margin of about 0.9. That's itself not changing. So to borrow at 0, that means the OCR's got to be, or the bank bill rate's got to be, say, 0.5, minus 0.5, and our margin's got to be 0.5. So that'll net off to 0. So it'd be challenging. Only short dated stuff will be at that below 0.5% in terms of margins. Margins have been creeping up as well because of all this negative interest rate, investors wanting a return. So that's how the thing moves.
Yeah, that's a good point. Sorry, Mohan, I should have alluded to that. With the benchmark, it excludes margin, because that's something we can't control. We can't hedge that. That's the market. So it excludes that, and this is purely the interest rate risk.
Thank you, Larry. I think you had a question.
Yeah, thanks. And thanks for the offer to sort of delve into this, because it is around the hedging and, you know, the risk and all that we get out of our depth. And I believe we've been well served here for many years with good advice and good management of our debt. But we're in different territory now. So this in front of us is getting more flexibility, I think, which was asked for at the last meeting. But still, for those of us who are residential borrowers and those of us who are, you know, like here, when we sit here as corporate borrowers, it's this area of how much risk do you try and avoid, how much do you pay to try and change that risk in 10, 15, 20 years' time, whereas I'd just go out and borrow it, you know, as long as I could for as cheap as I could. So how much do we generally pay for hedging? You know, how much are we putting there for the 10-year, the 15-year, 5-year, whatever it might be? Because we're dealing with ratepayer funds, and, you know, it's still a gamble when no one knows the future. Can you give us a little bit more clarity about how that hedging works and why you do it, instead of just thinking, well, it's going to be like this for 10 years, let's take what we can and wait and see.
Yep. Oh, okay. I mean, yeah.
Question?
Yeah, I think I get what you're going at. You know, hedging obviously was to give the council certainty over its cost of funds, because you do have long-term plans. You go through these LTPs when you set your budgets, which are normally 10 years, right? Which are 10 years, and then they're sort of refreshed every 3. So we've always sort of perceived that the real interest rate risk that you have is somewhere between 3 and 10, and then you end up at 7, which is kind of the midpoint now at our tail, 7 to 8. And so there's always been a need to make sure you manage your interest risk from upside. Now, as it has played out, there's certainly not been any upside since the GFC, because all we've done is trailed down. And, you know, our view has always been that, you know, the floating rate has been a huge part of the flexibility to a policy, which is why you don't hedge 100%. And certainly paying up the curve and going out 10, 15 years now is you know, 10-year swaps 0.5, you know, but it used to be 5%. So it's still, you know, the benefits have outweighed doing all that long-term hedging. So therefore that's one of the key reasons we're shorter duration. And so the game really has changed a lot. But you still need to do some hedging, we believe, but it's not to the extent that we used to, because the upside risks aren't there. Now, we're about to, as we mentioned earlier, we're going into negative rate territory. It's highly likely, and that's actually a problem for hedging, because it turns it upside down. Because where you pay fixed, now you're going to receive, and then it all gets tangled up and reverses. And so that's the problem for a lot of councils and corporates, which are not running to do hedges at the moment because of this issue that's going to unfold. But at some point when rates start to come up, I'm sure we'll get signs. It's not like we're at 0.5 at the moment, suddenly swap rates will jump to 3%. There will be some sort of guidance that comes in due course where the council would be able to look at doing something longer and meaningful, but now is just not the time.
Just because, again, just trying to put it into the context of where our ratepayers sit. You know, we look at a situation where we're eyes are watering about getting a sub 2.5 mortgage rate thing, but floating is still somewhere around 4 plus. So in that environment, you'd make different decisions. But you know, we're talking about 0.5, we're talking about less than 1%, and then, you know, the difference between floating and fixed, it's much smaller, isn't it?
Well, that's...
And so it's just totally different.
Yeah, the banking games are very different, right? So they want you to fix. So you always, and if you ever had a mortgage, the best thing you could ever do is fix for 1 year. But part of their strategy is to lock you in. If you're floating, you can change banks very quickly. So these 1 and 18 month and 2 years are really teasers to get you, lock you in. And they form part of the curve, and then they say, look, we're funding at the short end, therefore we're higher cost. So that's just the reality of the mortgage market.
And the other point you just made, because we have the LGFA, we don't have to change banks.
No.
Perhaps, so quickly.
Yeah, and in fact, you know, the LGFA has been a fantastic success, and continues to grow and continues to offer products and flexibility, you know, short-term funding, as, you know, facilities type thing, similar to a bank. So, you know, we don't see much in the landscape now for banks to local authorities, you know, 10 million here, 20 million overdraft for some unknown that may eventuate, and that's about it, really.
I could make a comment, add to your question. For example, if you decide to borrow for 10 years, so 10-year rate, the base rate is 0.5 or whatever. However, versus borrowing for, say, 3 years, the margin for that 3 year might be only 0.3. For the 10-year will be 0.7 on top of the base rate. So you're paying a higher cost being longer term. So the expectation is that 3 years from now or 2 years from now, rates could be still the same. So you could do it again. It's like not doing the fixed rate 3 year versus residential mortgage, doing 1 year, then 1 year from now still might get a 2.5%. rather than go for 3.5 for the longer term. So that's the same logic for the for council wholesale market.
Appreciate the invitation from the chair for people to get into this space. You know, when people start talking about margins, most people understand the liquidity risk or interest rate risk, but when you start talking about swaps and swaptions and margins, I get the feeling that a few people are starting to leave the room, and anyone looking online is probably now looking at, you know, what's happening tonight on TV. So there's the invitation to ask in this space is really important. I don't want to talk about interest rate risk or liquidity risk. I want to talk about comms risk or reputation risk. We've got a thing here which someone will put out and say, we're missing our benchmark, we've missed our benchmark, we can't get to our benchmark. How do we communicate this in the public domain? And it goes back to a conversation that was raised around LTP, non-financial performance. We set often ourselves up to fail by putting a whole lot of targets in place or using words that suggest things are targets, and then the numbers don't go in our favour, and we wind up with reputational damage because of it. Bit of a theme for today for me. How do we manage this or communicate this in a way that when the Bay of Plenty Times gets it and they talk about this is the benchmark and this is where council is currently sitting, we manage that reputational risk? Are we giving thought to that issue?
Through the chair, we haven't given thought to actually putting anything out. We certainly can, and I think the answer is actually in explaining some of that detail in terms of the reason that hedging takes place in the first instance around that security of rate setting over a period of time, and you know, minimising that upside risk which has been there in the past, which is why it was done. However, it has unwound considerably now, and the fact is the policy actually starts to reflect that upside risk, you know, reducing. However, still requires some hedging in place. So, you know, we can have the conversation in terms of, you know, whether we need to put any comms together around explaining that further.
Just adding to that, if you go back in time a little bit before COVID, and if you look at that benchmark metrics, how it's calculated, you know, it had 30% of it's based on the 90-day rate. 9-day rate was 3%, so 30% of that, you see how the benchmark has changed. But our average cost of funds has come down slowly. It doesn't have this big jump. So that's probably the, you know, if I go back 12 months even, it's quite different. So, but our average rate was a little bit higher, and we know it was coming down. So as the hedging drops off, you know, so yeah.
And just a final point too, you know, the all-up cost of funds are not anywhere, they're within the range of what we see across all local authorities. And, you know, the ones that are lower, or even substantially lower, don't have much debt. So, you know, they might have 50 million of debt, so it's completely skewed to the bottom. But, you know, you've got to think about Tauranga as one of the larger councils, so they're not unreasonable if you compare it to other.
I think here I sit with Councillor Baldock. I think we have been well served by our Treasury management function for a very long period of time. But this chart is in the public domain. It's been in the public domain for a number of days. There are people who choose to see what they choose to see. It looks like we have a benchmark we're not meeting. It can be presented in a certain way. Perhaps the answer is Mohan sits with someone from the media if they want to look at this topic so they get a proper understanding before they go to print.
Oh. I'll ask the question of Paul, really, but maybe the Chief Executive, but we don't consult on this, and yet it's pretty large. But can you give any insight into the rationale that we don't have to? I mean, obviously, you could consult on this and most people would go, you know, glazed eyes. So, but it is an opportunity to get some information out, perhaps, to the public.
I think you answered the question well in terms of that, but yeah, we don't consult on it specifically. It's part of our cost structure, effectively. That is the result of the annual plans and long-term plans that are set, and we manage this in a way to effectively in the best interest of ratepayers, effectively. We could put some communication out as part of, particularly when I think it's important to note that the size of our capital programs and as we move through the LTP is that our cost structure is, even though interest rates are low, is still moving towards a more capital-based cost structure. So there is more and more cost that is actually flowing into our annual OPEX levels because of the size of that continually growing capital program. And this is a key component of how it's managed going forward.
So thank you for your input, Larry. Oh, sorry, Larry, you got more to say?
Supplementary to Paul, if I can, I just think the public are less aware of that capital nature than the sort of what they see in there, that our current borrowing is still at 3 point something %, and yet, they see these other figures of 0 point. That's the communication we could explain as quickly and as easily for someone like me, which is why I ask those questions, that they can see there is a difference and that we're trending down in that average, but it's all good news.
We can put some thinking into how best to do that, particularly as we move into that long-term plan process.
Yes, John, final question.
Happy to move.
Thank you. So that's both, I presume both, that we received the report, but also, and I just want to draw attention to this, John, we are going to approve the amended policy has been developed by Suresh and Ross, with those modifications recognising that we had been informed of the three key things: the interest exposure, the liquidity funding risk, and the measuring performance metric, which we've just discussed at length. So thank you. John's moving that to a seconder. Thank you, Kelvin. Is there any discussion on the motion? John, Kelvin, you want to speak to the motion? No?
Very quickly, I doubt whether the Bay Plenty Times will pick up the story. Thank you.
Perhaps reflecting Larry's thoughts about consultation, perhaps proactive engagement with the community is not a bad thing. So I take the view of the floor as good, and I hear a commitment from Paul that we'll look at that. So I hope that's something we can look at and act on. I'll put the motion. All those in favour, please say aye. Aye. Those against? It's carried. Thank you very much, Mohan. Thank you, Suresh. Ross, appreciate your presence again this morning as well. That's helpful, and it will be important for us as we go into the LTP. Well, not go into, we're into it already, but as we deal with the LTP. So thank you very much for your time. Appreciate that. Could I move us then, please, to item 9.2, which is really a bit of administrative stuff, but again reflects back on our presenters earlier this morning from LGFA, where we've got an AGM coming up, I think on the 19th, if my notes are right. Mohan, you're still there, so please tell us your views, and I think we'll get some decisions to make.
Thank you. This is the usual annual AGM coming up on the 19th. This time it's got a few options to consider. Philip Corey-Wright, as an independent director, come up for a re-election, and there's no other options there in that item. And then there's one new person has come into the seeking election for the non-independent director. Mike Timmer annually rotates since there's only one non-independent director, and Wayne Maxwell has put his name forward. We've gone through a process in terms of the Shareholders' Council. Consider that we're supporting Mike Timmer, the incumbent. And the other item is there's annually two the nominated councils rotate, and this year it's Tasman and Wellington. And New Plymouth has put their name forward for election into that group. There are 9 councils in the Shareholders' Council. We've been there, Tauranga City has been there since the start. And Wellington, as in the report, Wellington, like ourselves, is a large borrower, and Tasman and New Plymouth are smaller borrowers. However, Tasman's got the same shareholding as us, paid up capital of 1.86 million. And Tasman was the second year entrant into the shareholders, and they've got about 100,000 at this stage. So that's sort of the item which Shareholders' Council didn't consider, which to support or recommend at this stage. I'm not sure what the other members are considering at this stage in terms of which council. It was always the idea that we should have some rotation. That's the idea behind the setup, that every year 2 councils will rotate and put their name forward they wish to seek re-election. Same with the directors. So, and then the other changes with the foundation policy, which are sort of more mechanical in terms of the size of the balance sheet growing for LGFA.
Thanks, Marn. Appreciate that. So, look, perhaps to just guide us through the conversation, could I firstly, I will open the floor up just for general questions or comments, which would be useful. Then let's try and see which of the alternatives, or even a further one, but I mean essentially the alternatives that Marn's put here in terms of the paper we want to we will have a consensus or resolve on. In other words, are we going for the either or the or, and which are the 2 councils? I'd also just note that actually, in terms of the completeness of the papers, it is also to reflect that the foundation policy has some changes there too, which I think, if you had a chance, are reasonably straightforward. But again, your chance to ask Marn that question. So, first of all, before we get to the actual pick, are there general questions for Mohan or comments that people would like to make? Kelvin?
Yeah, thanks, Mohan. You mentioned Tasman District Council $100,000. Can you elaborate what that you were referring to?
Speaker, please, Marn. Thank you.
Capital, paid up capital, $100,000, yes.
And Tasman is a unitary, is it not? There's a difference between the others, so I don't know if that makes any influence.
Are there any other questions for Marn? Okay, can we look please then at the actual nature of the motion? Obviously receives, and then we've got some resolutions as you've indicated, Philip Corey. Sorry, firstly, if you haven't, you will recall that the Shareholders Council has considered this, as you have helpfully pointed out to us, and we have a letter from Alan Adcock, which actually outlines the Shareholder Council's view, okay, for which their view is, obviously Philip Corey Wright is a situation where there is no other option. We have the choice between Michael Timmer and Wayne Maxwell, and the council has said Michael Timmer for the reasons that they outline in the letter, but they leave it open in terms of the councils that are returned to the Shareholder Council, and they have recommended that we actually approve the foundation. So that's their guidance. Can I get a sense of whether we are going to go with that guidance in terms of Mike Timmer or Wayne Maxwell? You happy to go with the recommendation for Mike Timmer? Okay. Can we have a sense of the 2 councils that we need to nominate?
Could I just ask another quick?
Yeah, sure.
Just, are there any other unitaries in the shareholder? Yeah. It's just occurring to me as I speak. But are we?
No. There's Auckland, Christchurch, Wellington, Tauranga, Western Bay of Plenty Regional Council, Wellington, then Tasman at the moment, and Whangarei.
And for what it's worth, Larry, Auckland is akin to a unitary anyway. So it's a bit difficult. I think perhaps when we were talking with LGFA, we had a sense of a bit of representation across the country, noting the good concentration from this end of the territory. Is there a view that people want to express here? So, what? Give me right. Tasman and Wellington will be returning the existing members, correct? And New Plymouth would be a choice of bringing somebody new on board.
Correct.
I know we. Thank you. Well, you'll move the whole lot, but your preference is going to be Tasman and Wellington. Thank you, Kelvin. I sense there's. Thank you, Larry. I sense that it probably is where we're going to land without any other strong sense. So, Robin, if we could note then that the motion will be that we go for 2A, which is approving the re-election of Mike Timmer, and 3, will be nominating Tasman and Wellington. I've got that correct for you, Kelvin. So Kelvin moves and Larry is seconding. I'll put that motion, please. All those in favour, please say aye. Aye. Those against? It's carried. Thanks a lot. Appreciate that, and thank you for your leadership there, Kelvin. That's great to get me through that. I was a bit worried there for a moment. Okay, that's cool. Thank you, Martin. Appreciate your time again, buddy. So if we can move on from 9.2 on to 9.3, which is the financial quarterly report. Catherine, welcome, and I appreciate your work. It's great to have you here.
So good morning, councillors. So this is the first quarterly report for the year. This particular report is the financial results only for the quarter. Normally we'll have non-financial as well, but due to the timing of the resident survey data, we've gone ahead with just the financial report, and that non-financial material will come to you in the December meeting. So overall, we provided you with the statement of comprehensive revenue and expense, which I just put up on the screen in case there's any questions. And that shows the operational results for revenue and expenditure for the first quarter. Normally we provide by activity a breakdown of revenue and expenditure. We haven't done that for this first quarter just due to really workload pressure, and it is less material in the early stages, but we'll definitely bring that back in December for you. Overall, revenue is tracking slightly favourably to budget, and I will draw your attention to our other revenue, which is primarily our user fees. They are slightly up on budget, so this morning LGFA mentioned about the challenges post-COVID with revenue. When we did the annual plan, we revised downward those revenue budgets, so we're performing well to that, particularly the regulatory area, which we were a bit too bearish on perhaps, and the airport also is achieving slightly favourably to those revised budgets. Before I move on to the capital, were there any questions on any of the operating results to date?
Any questions on the operating result, folk? No, we're going to get to the CapEx next, Larry. Are there any questions on the operational side? I wonder if I just had one, Catherine. I think it just really is a follow up on I think the point that you were making before, and it was just in paragraph 8 where we noted that I suppose it's a balance sheet one, but it also relates to revenue. Sorry, we were saying net debt was at 517, which is below where we had anticipated due to rates received from the August instalment. I was slightly interested in that comment. Was there something exceptional about our August collection that we hadn't been able to anticipate?
No, it's just explaining why we have that peak again, because we do that first rates instalment and normally bring most of the rates in at that point.
Yeah, and the other question then I had was relationship to the personal expense, where expenditure hasn't been capitalised. Will that be eventually capitalised by the time the project is finished, or is that carried forward as a variance in the personnel line?
That's something we'll be monitoring. There may be some variance. The capital delivery, when we get to that part, is slow to start, so it would be expected to be less capitalisation at this stage, but we will be monitoring and working with the team on that.
Yeah, I always look at development contributions as a sort of indication of what's going on, and it's up 2.7 mil. Is there anyone that can comment on any obvious things you can notice in that? Things are obviously going gangbusters out there in the housing market, but it was above budget, so it's, you know, nothing. If Christine was here, I'm sure she'd give some insight into it, maybe.
I think we did reduce the budget down for development contributions for the year. I think everyone's a little bit trying to keep up with what's going on in the housing market in terms of what those forecasts look like. So we'll just keep monitoring that.
Catherine, if you could move on to the CapEx or the capital side, I'd appreciate that in the balance sheet.
As discussed, we usually have a slow start to the year for capital, and as new projects ramp up, and this year was no exception, and probably is just a little bit lower than normal. There were the comments, and I don't know if you would like to speak about this, Nick, but in my area in particular, there's been some slower start than was originally budgeted.
Yeah, I can comment on that. So, like Catherine says, it's not a linear spend through the year. It looks more like an S-curve, so we have a flat start and a flat finish, which means sort of over the winter time it is slower spend, and this forecast wasn't cash flowed for the year. Waiari is a third of our spend for the year, or thereabouts, and a couple of components of that are going a bit slower than expected. The pipeline works are going really well, but the balance of plant contract, which we let about a month and a half ago, we spent a lot of time negotiating that. So it was our intention to get started on the balance of plant much earlier than we did, probably by a couple of months from the top of my head. So that makes a big difference. We're also struggling still to get out of the ground for the intake structure. So that's going a bit slower than expected. But once we are, we're back on track just in terms of the. I dislike the term burn rate, but the steepness of the expenditure will come back on track. And we have a few plans to increase the spend towards the end of the year. This is one of those instances where we don't want to pay a premium for increased or accelerated expenditure either. So for Waiari, for instance, the Ballison plant, which we let later than expected, it doesn't actually matter if we cut the ribbon on that part of the project a little bit later, because there are other components that are on the critical path. So we just let that run its course. What we are looking at, though, for an increased spend towards the end of the year is, like Andrew and John mentioned early on, the stimulus package for the three waters that will boost our expenditure towards the end of the year. We also have the Cameron Road, which we hadn't budgeted for in this year. We're looking at early works in the May time, thereabouts. So we might see about a $4 to $5 million expenditure on that project. So a few things like that we're bringing forward from future years. So year end will not trend to these numbers.
Nick, appreciate that. Yes, Heidi.
Can I just ask about that Three Waters money from government? So some of it comes into this year and some of it comes into following 1 year or two?
That's right. So the next 2 years. And the point of that was that it was stimulus. So the works are works that we hadn't scheduled for this year in the first place.
Right, thank you. So the more questions for either Nick or indeed Catherine over the capital and balance sheet side of our performance. Yes, John.
Happy to move if there are no further questions.
Didn't have one little question, but I will take your motion. But if I could just get my question in first, that would be absolutely great. Look, Catherine, I just noted a couple of things. I think I just wanted to note that actually the Treasury compliance report on page 109, I think it is worthwhile for us in our role as a Finance Audit and Risk Committee to note that the covenants are still within the parameters that we have set. It's an important little box, and it's one that we should always be worried about, that we keep ourselves on track. So I would appreciate we're only at first quarter, but with the sense of that we will basically have the financial outturn that we currently budget, that we are not worried about those covenants at this stage. They will be within what we anticipate by year end.
Yes, that's correct. The projection at the moment for year-end debt levels is about 36 million less than budget, similar to the capital underspend protection.
Yes, Heidi.
Just ask another question around the waste government funding. Have we had any word about whether that funding is coming in or not?
Look, we're still working with government on that.
Right. Okay, thank you for that, Heidi. So look, sorry about that, John. I appreciated your motion, so that's good. John's moved that we receive this report. Is there a seconder, please? Thank you. Tembi, do you guys want to talk to the motion? You're happy? Okay, well in that case, I'll put the motion that we, if I recall right, do it that we receive Catherine's fine report. All those in favour, please say aye.
Aye.
Those against? It's carried. Thank you very much.
Into public excluded.
Yes, yes. So I will, from the chair, get us ready for post-morning tea, which is to move that we go into public excluded for the reasons. And I just want to check, obviously, Basil, you're most welcome for your role to still be here with us in the excluded. I don't think we need to necessarily pass the motion on that, but to note it. So look, I will move that we move into public excluded. Thank you, Tina. All those in favour, please say aye. Aye. Those against? It's carried. Can we be back, please, at 11:10? You've got an extra 3 minutes. That's not bad, is it? Thank you, Robin. You kept us online, okay?